Hello and welcome to our webinar on passive foreign investment companies, or PFICs. My name is Jimmy Sexton. I will be your presenter today. To begin, we'll start off with a brief disclaimer. This presentation was prepared for information purposes only. This presentation was also prepared for educational purposes only. This presentation is not legal or tax advice, nor is it to be construed as such. Each individual's circumstances are different. You should seek legal and or tax advice to address any specific questions you may have. A little bit about my background. I have a bachelor's in business administration with an emphasis in finance, a JD, an LLM in international taxation. I'm the president of Esquire Group. We're an international tax advisory firm with offices in Austria, Germany, the United Arab Emirates, and the United States. We specialize in international taxation, including tax issues facing U.S. citizens and resident aliens living abroad, expatriation, investing or doing business abroad, and or foreign investment in the U.S. I'm also fluent in English and German. Before we jump into our first informational slide here, you'll see that you do have the ability to ask questions in your GoToWebinar console. Feel free to go ahead and ask questions, and I will do my best to answer them at the end of the presentation. Please be aware that I'll only be answering general questions. If you're asking specific questions about your situation, we'll be skipping those. All right, so moving into our first informational slide here. A lot of people hear passive foreign investment companies or PFICs, and they think, well, they don't even pay attention to what it is. They just think this doesn't apply to me. I for sure don't have one of these. Sounds really complicated, something that only big companies have. And in fact, that's not the truth. It affects more people than realize it. And so today we're going to talk a little bit about what they are and how they're taxed and what impact that they can have. So a passive foreign investment corporation is a foreign corporation where 75% or more of the corporation's income for the year is passive income, or 50% or more of the corporation's assets produce passive income or are held for the production of passive income. So the first question then becomes, what is passive income? So passive income, generally speaking, is income that is generated from non-active activities, so investment activities. So we're talking about dividends, interest, royalties, rents, and capital gains. So if you have a foreign corporation and 75% or more of that corporation's income for the year consists of dividends, interest, royalties, rents, and capital gains, it would be a passive foreign investment company, or PFIC. Likewise, if 50% or more of the corporation's assets produced income, such as were held for the production of income, such as dividends, interest, royalties, rents, and capital gains, it would also be considered a passive foreign investment company. So what are these? The most common PFICs are foreign mutual funds, foreign hedge funds, and foreign investment companies. These are basically funds that investors buy a share of, and those funds then invest in other securities. And therefore, the assets of that fund primarily are going to generate passive income, and the assets that are within that fund are held for the production of passive income, making it a passive foreign investment company. So assuming that you did have a passive foreign investment company, what would be your filing requirements? So first, you'd be required to file Form 8621 with your income tax return. Now, there is an exception where if the total value of your PFICs are less than $25,000, you would not be required to file Form 8621 with your tax return. But please note that that's a cumulative value. So you have to add up the value of all your PFICs, and if that aggregate value is less than $25,000, then you would not be required to file Form 8621. It's not a per PFIC limitation. Also, if the PFICs were not held through some type of a brokerage account or something like that, you would also have to report them on your FBAR. A perfect example of this would be, let's say, for example, you had a brokerage account in Germany, and within that brokerage account in Germany, you held PFICs. You would be required, assuming that you met the FBAR filing threshold of $10,000, you would be required to report the overall brokerage account that you have in Germany. You'd have to file 8621 with your tax return to report the PFIC, but you would not have to file a separate FBAR to report that PFIC. There's some countries, for example, where you can buy physical shares in foreign mutual funds, for example, and so those shares would not be held through some type of a brokerage account, but it would be a direct interest in that PFIC. In that case, you would be required to report that PFIC on your FBAR as well, assuming again that you were over the $10,000 FBAR filing threshold. So let's talk a little bit about how PFICs are taxed. So ordinary distributions from PFICs, so what most people would think of as dividends, basically the returns that they earn on owning their PFICs, are taxed as ordinary income, much like regular dividends. Gains from dispositions, so gains from selling PFICs, as well as what are known as excess distributions, are taxed differently. And they're taxed in a very draconian way, and we'll go through that a little bit. But first, let's talk briefly about what an excess distribution is. An excess distribution is any portion of a distribution that is greater than 125% of the average distributions received during the 3 preceding years. So let's assume you've owned this PFIC for 5 years. The way you would calculate your excess distributions is you would add up all the distributions over the last 3 years and divide that by 3 to figure out what the average is. Then you would multiply that times 1.25, and any amount of the distributions above that number would be considered excess distribution. So gains and excess distributions are taxed the same, and they're taxed as follows. First of all, gains are not eligible for long-term capital gains tax rates. Also, the gains and excess distributions have to be allocated to the prior years in the holding period. What that means is you basically, for however long you own the PFIC, you have to figure out how much gain is allocable to each year in that holding period. So again, if you owned the PFIC for 5 years, you'd have to divide the total gain by the total number of days that you owned the stock, and then you'd have to figure out how many days were in each of the years that you owned the PFIC, and then multiply the number of days that you held it in each year times the gain, and that will give you the amount of gain allocable to each year. The gain in that for each year is then taxed at the highest tax rate then in effect. So even if your actual tax rate in that year was, say, 25%, your PFIC would be taxed at the highest tax rate that was in effect that year, which could be up to 39.6. And then you have to pay tax on that gain or excess, you have to pay interest on the tax as if you should have paid that tax in one of the earlier years. So let's say, for example, you sold a PFIC that you owned for 5 years. So you figure out that in each one of these 5 years, there was $1,000 worth of gain. So you would go to year one, you'd say it's $1,000 of gain is allocable to this year. You would say the maximum tax rate in that year was 35%. So you'd owe $350 of tax for year one. Then you have to calculate interest as if you should have paid that $350 worth of tax 5 years ago. And then you add that interest charge to that tax, and that is the amount of tax for year one that is going to be due for your current year, the year of sale or excess distribution. And you have to do that for each one of the 5 years, and then you add that amount together. And again, I'm using 5 years as an example, but it's really, you have to do that calculation for your entire holding period. So if it was 5 years, if it was 2 years, I was just using 5 years as an example. Now, there are a couple of elections that can be made to make the taxation of PFICs a little less draconian. The most common elections are the mark-to-market election. The mark-to-market election can really only be used with publicly traded PFIC. So if you have a publicly traded mutual fund or something like this, the mark-to-market election can be very useful. And the way the mark-to-market election works is that dividends and distributions are taxed as ordinary income, just like most dividends from normal securities. And then every year you pay tax on the increase or decrease in the value of the publicly traded PFIC. So basically what you do is you look at what the value of the PFIC was during the beginning of the year or whenever you purchased it during the year, and then you look at the value of the PFIC at the end of the year. If the PFIC went up in value, you pay tax on that increase in value. If the PFIC went down in value, then you wouldn't have any tax. You are able to take mark-to-market losses to the extent that you took any mark-to-market gains in prior years. The big advantage to this is when you go to sell a PFIC, you don't have to do this calculation with allocating gain to prior years and figuring out the interest charge and all that stuff, like with the default method, because under that default method, a lot of times any gain that you would have made would be completely eliminated. Then the other election that is common if the PFIC provides detailed enough information in order for this election to be possible is what's known as the Qualified Electing Fund or QEF election. And basically, you have to pay tax on your share of the ordinary income and capital gains annually. So there's some PFICs that provide a statement that say, per PFIC share, there was X amount of ordinary income and X amount of capital gain. And then you would take that information, multiply it times the number of shares that you owned, and that would be what you would include on your taxes. The other advantage to the QEF election is there is capital gain treatment when it's disposed of, assuming that there's a gain. But again, there's only very limited PFICs that actually provide detailed enough information to be able to make the QEF election. But it is a very useful election if the sufficient information is provided by the PFIC. That takes us to the end of the presentation.